Good morning, everyone. Right now, tens of thousands of small business owners in the United States are turning to SBA programs and traditional banks, convinced that the problem is paperwork, credit score, or just one more form. But the data tells a different story. The Small Business Credit Survey shows that in 2024, only about 41% of small business loan applicants received the full amount they requested, while another 36% got partial funding and 24% were denied entirely. Among different loan types, Small Business Administration or SBA loan or line of credit or LOC applicants experienced a 45% denial rate in 2024, more than double the 21% rate across all types. Those numbers are not accidents. They are the output of a system designed to protect bank balance sheets, not to make your business grow. And here is the hidden truth most financial advisors will never tell you. If your business is structured correctly, your loan is not a risk for the bank. It is a highly desirable asset that multiple lenders will compete to hold. Small business loans, especially those under the SBA 7A umbrella, are regularly originated by banks that then sell many of those loans or their cash flows into the secondary market, packaging them alongside other income-producing assets. When you understand that, everything changes. You stop asking, how can I get a loan? And you start asking, how can I design my business so that banks treat me like a prime grade borrower and not a charity case? That is exactly what we will build today. At the end of this video, I will also give you the Bank Grade Borrower Checklist US 7A edition, which you can simply copy-paste, fill it out, and hand it to your banker. It will show them that you aren't a customer, you are a professional who understands their balance sheet. That alone can save 50 to 100 basic points of your interest rate. The first 45 seconds should have already shifted your mental model. That is not a how to apply for a loan video. It is a capital architecture video. We will treat your business as if you were a small private bank and your small business loan is a deposit-like liability that funds your highly profitable assets. Our goal is precision, not puffery. Let's start with the macro picture, then zoom into the mechanics of why small business loans exist in the structure they do, who profits from them, and how you can operate inside that system so that you are not just surviving, but designing the game. Now, the very basic question is, why small business loans exist? At the Federal Reserve and Wall Street level, the motivation is simpler. Small businesses is the largest private employer in the US economy, and it needs cheap, predictable, long-term financing. If you look at the delinquency rate on business loans for all commercial banks, it is currently hovering around 1.3 in late 2025, 1.3%. That is an extraordinary low delinquency rate compared with historical peaks above 6% during the 1980s. In other words, when banks lend to small business, they are usually not reaching into the junk bond bucket. They are often dealing with a relative stable, low default asset class. The SBA 7A program, which is the largest small business loan program in the country, has an average 5-year default rate, historically around 5.2%. And in fiscal year 2024, the 1-year default rate at 7A loans was about 3.69%. Those numbers are not zero, but they are low enough that banks can build entire businesses around originating and selling these loans. That is why you see major institutions, regional banks, credit unions, and fintechs all showing up at the small business store. What does not work is the way most entrepreneurs approach these loans, as a last-minute emergency draw applied for with incomplete records, or poor structure, and a fundamental misunderstanding of the incentives driving the bank. The second most important understanding we need to have is who profits from these small business loans. See, when you sign for a small business loan, the money isn't just there. It's part of a massive chain of incentives. See, at the top of that chain, you have the bank's balance sheet. Regulators like the Fed are watching them constantly. They require every loan to be categorized, risk-weighted, and reserved against. So if your loan goes bad, it eats into their capital. It kills their lending capacity, and it invites the kind of scrutiny no bank wants. Now below that sits the secondary market buyer. This is the secret. Most banks don't actually keep your loan. They package them into pools and sell them to investors. Why? Because that SBA guarantee, the 75 to 85% coverage, it makes your debt safe for the big players. That means your loan isn't just a private contract with your local branch. It's a centralized claim on your future cash flow. It's being traded, scrutinized, and layered into the global financial system while you are just trying to learn your business. Then, at the bottom of the incentive stack sits you. If you get a good rate, long-term loan, and you deploy it efficiently, you are leveraging your own equity to compound returns. But if you treat it like a consumer-style advance, you are going to be just underlined on the regulator's default rate spreadsheet. Another data point for Fred. The key is to align your incentives with the banks. Give them predictable repayment. Give them low volatility. Show them clear documentation of your business's ability to survive that debt. When you do that, you shift from being a risk to being the price. Most how-to videos stop at preparing documents, but we are going deeper. We are asking, what does a bank's internal credit committee actually need to see before they approve a mid-six-figure exposure? To win at this level, you need to build what I call a bank-grade borrower profile. It's built on 3 pillars. Pillar number 1, cash flow transparency. The Federal Reserve's Small Business Credit Survey is clear. The number 1 reason for loan denial isn't a bad idea. It's messy financials. Banks hate guessing. They want to see 12 to 24 months of clean and auditable books. They want to see exactly where your seasonality hits and where your customer concentration lies. Think of this as your internal credit rating. If you present a credit-worthy entity, they plug you into the pricing engines and give you the best rates. If you present chaos, you pay for it, though higher interest, suffocating covenants, or an outright denial. Pillar number 2, collateral and risk layering. Under the SBA 7A program, you can go up to $5 million for real estate, equipment, or even AI-driven capital expenditures. A sophisticated borrower understands how to structure this. You match the debt to the asset. If you are buying equipment, you match the loan term to the useful life of that machine. If you are financing real estate, you align the amortization to your hold period. And for working capital, you tie those lines to your accounts receivable, not to fixed cost. That will crush you in the downturn. This isn't just financial engineering. It's risk matching. It's the exact same principle giant banks use when they build multi-billion-dollar tranches. Pillar number 3, the competition. And this is the insider move. The real relationship architecture. Data shows something counterintuitive. Small banks and credit unions actually approve small business loans at higher rates than the big rational players. In fact, one analysis shows that roughly 52% of applicants at small banks get full approval, while the big banks and online lenders lag way behind. Why? Because the small banks actually understand the local economy. They have the direction to look past a spreadsheet. A strategic borrower doesn't go to one bank and pray. You approach multiple institutions, small banks, credit unions, SBA-focused fintech. You signal that you are willing to move the entire relationship. You bring competition on the table, just like the private equity firm would. That is how you drive down your cost of capital. See, even if you master the mechanics of a loan, human psychology can still take you down. There are three traps that high income owners fall into, and they are often the difference between scaling up and burning out. The first is a good news trap. When a bank approves you for a larger loan than you expected, most owners treat it as a personal validation. They think the bank believes in me. In reality, the bank might be pricing that loan for a much higher default probability than you realize. Look at the data. The SBA 7A one-year default rate hit 3.69 in 2024, up from 2.76 just 2 years prior. Delinquencies are creeping higher because fast growth businesses often aren't as resilient as they look on paper. A top-level borrower doesn't react with euphoria. They react with stepped-up due diligence. They ask, if my revenue drops by 30% or 40%, how do I still survive this debt? That is the mindset of a strategist, not a lottery winner. The second trap is the growth illusion trap. People think more capital equals more growth. Statista and Federal Reserve data shows that only about 52% of applicants get full approval. When that capital finally hits your account, the temptation is to hire more people, buy more ads, and get a bigger office. But if your underlying unit economics are weak, more capital doesn't fix the problem. It just accelerates the burn. A bank thinks in risk-adjusted returns. If your business generates a 15% margin on new sales, a 7% loan is highly accretive. If your margin is 3%, that same loan is self-destructive. The uncomfortable insight here is that for many businesses, capital isn't the thing that's scarce. Profitable scale is. The third trap is set it and forget it relationship. Most entrepreneurs think once the papers are signed, the job is done. In reality, the reporting discipline you use during underwriting, that should be your new operating standard. If you treat your loan like a professional private equity trench, you maintain the kind of discipline that keeps banks eager to lend to you again. That means three things. 1. Keep your financials clean and timely. 2. Provide clear communication the second something goes off plan. And 3. Be willing to adjust your covenants when the business model changes rather than just hoping no one notices. Those behaviors are the invisible differentiators. They are the reason some borrowers are treated as one among many, while others are treated as a repeat client asset. Let's translate all of this into a concrete mental model. To win, you have to stop thinking like a business owner and start thinking like a highly trained banking expert. You need to think in balance sheet units. Step 1. Define your leverage multiple and your risk budget before you even walk into the bank. You need to know your limits. Ask yourself, what is the maximum debt service my business can tolerate in a worst case scenario? Give your current cash flow. What is the reasonable leverage multiple for growth, not just survival? Many SBA loans have long amortization periods and low interest rate caps. This allows you to hold debt at levels that would be aggressive for a consumer, but are actually prudent for a small business. The key, calibrate the loan size to your risk tolerance, not just to whatever the bank offers you. Step 2. Match the loan to a specific economic engine. Are you financing working capital like inventory or payroll? Are you financing capital expansion like new equipment or real estate? Or are you financing an acquisition? SBA 7A loans explicitly allow multiple purposes, including buying another business. But here is the data. Default rates on SBA finance acquisitions tend to be higher than the program's overall average. An intelligent borrower prices that risk. He treats an acquisition loan much more carefully than a working capital loan because the underlying risk-reward profile is completely different. Step number 3. Structure your trenches. Think like a bank structuring a multi-million-dollar portfolio. Use short-term working capital lines for your volatile cyclical needs. Use long-term loans for your durable income-producing assets. And most importantly, keep your equity as your shock absorber, not your only source of fuel. At the end of the day, a small business loan isn't just a deposit in your bank account. It's a specialized tool in your capital stack. If you are following this framework, you have done something that 99% of business owners never do. You haven't just applied for a loan. You have audited your own transparency. You have matched your debt to your assets. And you have built a competitive architecture that forces banks to bid for your business instead of you begging for theirs. That is the difference between surviving and scaling. Remember, in the US banking system, capital is rarely the bottleneck. Strategy is. When you align your incentives with the banks, when you provide that predictable repayment and low volatility, you stop being a risk profile on the spreadsheet. You become a partner. You become a prize. So what is the way forward? Before you sign that next term sheet, take a step back. Take a step back. Look at your leverage multiple. Look at your unit economics. Ask yourself, is this capital is truly accretive? Or if it's just a temporary band-aid? Because the goal isn't just to get the money. The goal is to build a business that is so resilient, so transparent, and so profitable that the banks are the ones calling you. If you are ready to stop guessing and start building a bank-grade business, hit that subscribe button. We are going to continue breaking down the elite financial strategies that the big players use to stay on top. I'm Shah Rahman. I'm a business transformation specialist with 16 plus years of experience spread across 5 countries. We will meet again in the next briefing. Take care.